Comcast Q2 2026. A clear beat on consensus across the top and bottom lines.
Huge beat, yeah.
Yeah, pro forma revenue landed at $29.56 billion, which is a 4.7% increase.
Right.
And pro forma adjusted EPS hit $1.04. Free cash flow is just a staggering $4.6 billion.
And massive.
Forward guidance confirmed the structural overhaul the market's been anticipating, and the stock is trading up modestly in response to the print. So for you, the retail investor, the mission today on this deep dive is to basically cut through the sheer volume of this earnings report.
There's a lot of noise.
Exactly. We're tearing apart the segment performance, analyzing the shifting profit margins, and looking really closely at the monumental forward guidance regarding a complete corporate fracture.
Well, we should probably establish right out the bat why those headline numbers are presented on a pro forma basis.
Right,
because the company you're evaluating today is structurally different from the companies that existed, this time last year.
Yeah, completely different footprint.
Exactly. Management completed the separation of Versent back in January of 2026, and they officially closed the sale of the Sky operations in Germany in May.
May 2026, right?
Yeah. So by utilizing the pro forma figures, we strip out the historical revenues and costs of those offloaded assets.
So it's an apples-to-apples comparison.
Basically, yeah. We're isolating the fundamental operating health of the current business, so you get a clean look at it.
And, isolating that fundamental health is super critical right now because of the overarching narrative driving the valuation of this stock for the next year.
Oh, for sure.
I mean, we're looking at a tectonic shift in corporate strategy here. Comcast officially announced its intention to separate NBC Universal and Sky into a new, completely independent, publicly traded company.
A tax-free spinoff.
Right, tax-free. And the timeline they provided puts the completion of this split roughly 12 months out.
It really reverses a decade of conventional Wall Street wisdom. Well, for years, the thesis pushed by these management teams was all about vertical synergy.
Right.
Right. You buy the distribution networks, and you buy the studios.
So you own both the physical fiber optic cables and the entertainment flowing through them.
Precisely. But recently, the market has aggressively penalized these conglomerates.
Because investors demand pure plays. Like, if you're a pension fund looking for a steady, cash-flowing telecom utility, you don't want exposure to the volatile, unpredictable box office of a Hollywood studio.
Right. You don't want that risk.
Yeah.
Cramming those two wildly different risk profiles into a single ticker symbol, it just forces a valuation discount.
Which is why they're engineering this divorce. But for anyone managing a portfolio right now, the most immediate consequence of this announcement is the shift in capital allocation.
Yeah, the buybacks.
Right. They returned $2.1 billion to shareholders in the second quarter. And that breaks down to $1.2 billion in dividend payments and $900 million in share repurchases.
Which is a lot of capital support.
It is. But management announced that as of July 1st, all share repurchases are paused while they establish the capital structures for the two future companies.
Yep.
So if you're holding this stock for stability, pulling nearly $1 billion of quarterly price support out of the market, I mean, that feels like pulling the safety net, right?
It does feel that way.
You lose that persistent buyer stepping in to artificially lower the share count. So should retail investors view this pause as a red flag for near-term volatility, or is it simply, mandatory financial housekeeping?
It is strictly mandatory housekeeping, though, it undeniably alters the trading dynamics of the stock.
Right.
When you execute a spin-off of this magnitude, you are essentially standing up two independent balance sheets completely from scratch.
Wow, yeah.
So both the legacy telecom parent and the new media spin-off need to secure investment-grade credit ratings.
Yeah.
Just to keep their borrowing costs manageable. And to do that, rating agencies demand total clarity on leverage ratios. You have to negotiate exactly how much debt the new media company inherits and how much cash the parent company retains.
And you obviously cannot aggressively drain your cash reserves to buy back stock while you're actively negotiating those leverage profiles.
Right. Draining liquidity while trying to prove your financial stability to a rating agency would be totally counterproductive.
Makes sense.
So the pause is prudent, but you are absolutely correct about the secondary effect. Without that $900 million quarterly bid acting as a floor, the stock will trade purely on the raw operational fundamentals.
And broader macroeconomic sentiment.
Exactly, for at least the next 4 quarters.
Which means we need to scrutinize those fundamentals, starting with the core business Comcast is actually keeping, the infrastructure, the pipes.
The connectivity and platforms division.
Right. Total revenue for the segment came in at $19.8 billion, which is a 3.2% year-over-year contraction. Adjusted EBITDA sat at $7.96 billion, yielding a 40.2% margin.
I mean, retaining a margin above 40% on shrinking revenue demonstrates intense cost control. But you really have to look under the hood at the subscriber metrics to understand the transition this division is navigating right now.
Yeah, because the broadband market in the U.S. is fully mature.
It's totally saturated.
Growth has stalled, and they are facing aggressive competitive pressure from fixed wireless access, which is essentially home internet powered by 5G cell towers.
Right, and specialized fiber overbuilders, too.
Yeah, and the subscriber bleed reflects that pressure. Residential broadband lost 167,000 customers. Management was quick to point out that this is a 34,000 subscriber improvement compared to the attrition rate we saw in the same quarter last year, but...
A loss is still a loss.
Exactly. And video, predictably, shed another 280,000 customers as the secular decline of linear cable just continues uninterrupted.
Yeah. Management explicitly addressed the revenue and EBITDA contraction on the call, attributing it to investments in a modernized go-to-market strategy.
So they're absorbing upfront costs now to reposition their bundled offerings.
Exactly. And they guided for modest sequential improvements starting in the third quarter as they lap those initial expenditures.
But the absolute centerpiece of that repositioning is the wireless division, right? I mean, it was the singular bright spot in the consumer segment.
It was huge.
Domestic wireless added a record-breaking 448,000 lines this quarter, pushing their total footprint past 10.2 million lines.
The runway there is the critical metric. Management highlighted that even with over 10 million active lines, their wireless penetration is still below 7% of their total addressable footprint.
Wow, less than 7%.
Yeah. So the white space to grow within their existing customer base is just vast. And these are not just cheap, dormant add-on lines used to pad the stats.
No.
No, 30% of their postpaid phone connections are on the premium unlimited tier, which drives really meaningful average revenue per user.
Wait, okay, hold on. If broadband is their ultimate cash cow and they're actively bleeding those users, their defensive response is to aggressively push these wireless lines to keep families locked in the ecosystem.
Yep, that's the play.
But Comcast operates as an MVNO, a mobile virtual network operator.
Right.
They don't own the cell towers. They lease capacity from Verizon.
Right.
Aren't they just trading a 90% margin broadband customer for a heavily capped, low-margin wireless customer? I mean, that sounds like a margin killer masquerading as growth.
That is the defining debate surrounding the telecom sector right now.
Okay.
In the short term, you are entirely correct. Operating as an MVNO means your gross margins are structurally capped because you have to hand a slice of every monthly bill back to Verizon for using their infrastructure.
Right.
So as the revenue mix shifts from pure high-margin proprietary broadband to bundled wholesale wireless, you experience margin compression.
Yeah.
That dynamic is precisely why the residential EBITDA margin dropped 150 basis points year over year down to 37.7%.
So the transition is actively eating into the bottom line.
Initially, yes.
Yeah.
But the calculus changes when you look at the lifetime value of the household.
Okay, how so?
The entire strategy is predicated on churn reduction. The cost of acquiring a new broadband customer is exorbitant. Marketing, shipping hardware, sending a technician to the house.
Sure, very expensive.
Right. So if a customer has only a standalone internet connection, they will cancel the moment a competitor offers a cheaper introductory rate.
Right, but if they have their home internet, their router, and like 3 iPhones all tied to a single Comcast bill, untangling that relationship becomes incredibly tedious.
Precisely. The friction to leave becomes way too high. The wireless lines act as a defensive moat, protecting the core broadband cash flow.
I see.
So while the immediate profit margin on the wireless line is thinner, extending the retention of the household from, say, 3 years to 7 years makes it a highly sustainable strategy.
That makes sense.
Furthermore, management noted that promotional, free wireless lines are increasingly converting into paying relationships over time, which will gradually improve those unit economics.
Well, speaking of unit economics that don't really need much help, business services was a standout performer. Revenue grew 3.7% to $2.67 billion, and the adjusted EBITDA margin was a remarkable 56.7%.
Yeah. Enterprise solutions are sort of the quiet engine room of the connectivity portfolio.
Definitely.
We are talking about multi-year business-to-business contracts for dedicated fiber, cybersecurity, and cloud routing. These contracts are incredibly sticky and carry phenomenal pricing power.
So when you envision the standalone telecom company that will exist after this corporate split, a division generating nearly $3 billion a quarter at a near 60% margin.
It provides incredible dividend security.
Exactly. But let's shift away from the infrastructure they're keeping and look at the programming they're spinning off, the content and experiences segment.
This was a massive quarter for them.
It really hit a notable financial inflection point. Total revenue jumped 22.9% to $10.7 billion. Media alone saw a 25.3% surge, reaching $5.69 billion.
Though we do need to contextualize that spike.
Right. Media revenue was heavily subsidized by $440 million in incremental revenue generated purely by the 2026 FIFA World Cup.
Live global sports introduced significant lumpiness into media earnings.
Yeah, huge spikes.
The World Cup is a powerful top-line driver, but it requires astronomical upfront programming costs to secure the broadcasting rights.
Sure.
However, even if you entirely strip out the World Cup revenue, the underlying media business still grew by nearly 16%.
Which is wild. And that underlying growth delivered the headline milestone of the quarter. Peacock achieved profitability.
Oh, finally.
Right. It generated $189 million in EBITDA, representing a $290 million positive swing year over year. They added 2 million paid subscribers, bringing the total base to 48 million.
And the primary drivers were the NBA playoffs, the World Cup, and on the reality television side, Love Island USA.
Yeah.
Crossing into the black is a huge psychological and financial threshold for legacy media. I mean, over the last 4 years, the streaming wars have been characterized by billions of dollars in operating losses.
Because these companies were desperately chasing Netflix's scale.
Exactly.
Mm-hmm.
Peacock has functioned as a strategic loss leader designed to absorb the inevitable erosion of the linear cable bundle.
Right.
Proving they have finally reached a scale where subscription revenue exceeds the fixed costs of content delivery and platform maintenance. That's a major validation of the strategy.
The narrative basically shifts from a required cash burn to an actual profit center.
Right.
But look at the bait they used to get those 2 million new subscribers. The NBA playoffs and the World Cup are massive, concentrated live events.
Yeah, they are.
People subscribe to watch their team, and then the moment the tournament ends, they cancel.
Hmm.
So how do you model sustainable momentum when your growth is reliant on short-term rentals? Are they facing a severe churn event in the third quarter?
Managing that churn is the core operational challenge here.
Mm.
Sports rights are essentially an incredibly expensive customer acquisition cost.
Right.
You purchase the NBA rights to force millions of viewers to download the application and input their credit card. The entire retention strategy hinges on migrating those sports viewers into the broader entertainment ecosystem, getting them hooked on Love Island USA or the NBC Universal back catalog before the tournament actually concludes.
So you have to convert them from a sports fan into a general entertainment consumer.
Yes. And the data suggests they are finding some real leverage there. Management pointed out that Peacock drove overall media EBITDA growth of 4%, even while absorbing the heavy first-year licensing costs of those new NBA rights.
Wow.
They also noted higher average rates per user, which indicates that consumers are accepting price hikes without just fleeing the platform.
And that back catalog and content pipeline brings us to the studios division, which delivered an exceptionally strong quarter. Revenue grew 25% to $3.04 billion, driven by a really dominant theatrical run.
Unbelievable run.
The Super Mario Galaxy movie crossed $1 billion at the box office this year, pushing the cumulative value of that specific franchise past $2 billion. And on the prestige side, Obsession grossed over $400 million, securing its place as Focus Features' highest-grossing film of all time.
The studio is really executing a barbell strategy with remarkable precision right now.
A barbell strategy.
Yeah, so on one end of the barbell, you deploy heavy capital into globally recognized, highly monetizable intellectual property like Super Mario.
Right.
That intellectual property generates immediate box office returns, but its real value is structural. It acts as the infrastructure for the broader company. It feeds the theme park attractions, it drives consumer products, and it eventually anchors the Peacock streaming library.
It essentially pays the overhead for the entire division.
Precisely. Then, on the other end of the barbell, you have Focus Features operating almost like a venture capital arm.
Okay.
They produce mid-budget, highly targeted specialty films like Obsession. The financial risk is relatively low, but when one of those bets connects with the cultural zeitgeist, the return on invested capital is exponential. That dual approach is why studio EBITDA surged by $141 million compared to the same quarter last year.
Incredible operating leverage when both ends of the barbell actually perform. But while the media and studio segments outperformed, we really have to address the glaring risk factor in this report: theme parks.
Yeah, the warning light.
Top-line revenue actually ticked up 2.7% to $2.4 billion, but that increase was largely driven by the successful opening of the Epic Universe Gate in Orlando in May of 2025.
Right. The revenue figure is slightly inflated by that added capacity. When you open an entirely new park like Epic Universe, you invariably see a surge in ticket sales, purely from the novelty factor and the expanded physical footprint.
But the profitability tells the real story here. Adjusted EBITDA for the theme parks dropped 5.1% to $609 million, which management attributed to higher operating costs.
Yeah.
And the commentary on the earnings call is where the warning lights really start flashing for the broader economy. Management explicitly disclosed that broader resort attendance in Orlando began softening in June.
That's the key.
And they project that downward trend will continue throughout the third quarter. They also noted that Universal Japan is facing continued pressure, primarily due to localized China-related travel restrictions.
The friction in Japan is a geopolitical and localized travel issue. The softening attendance in Orlando, however, is a direct macroeconomic indicator.
Okay.
Theme parks are governed by brutal operating leverage. The fixed costs are astronomical. You have to power the roller coasters, staff the restaurants, and maintain the landscaping, whether the park is at 100% capacity or 70% capacity.
So when attendance dips by 5%, your profits don't just dip by 5%. They contract sharply because the expenses remain completely static.
Exactly. The lost revenue falls straight out of the profit margin.
So let's focus on what that softening attendance tells the retail investor about the broader economy. A family vacation to Orlando requires flights, hotels, daily admission tickets, significant food and beverage spending. Is a dip in theme park attendance the ultimate early warning system for middle-class liquidity?
Historically, yes. It is one of the most reliable barometers for discretionary capital. Wow. When inflation bites into household budgets or broader economic anxiety rises, families do not typically cancel their vacations outright. They trade down.
Oh, I see.
A 5-day immersive stay at a premium Universal resort gets downgraded to a 3-day weekend trip, or they opt for a regional road trip instead.
So they cut the margins without entirely cutting the experience.
Yes. The fact that management isolated June as the inflection point and sees it accelerating into the current quarter suggests that the cumulative weight of persistent inflation and perhaps the final exhaustion of pandemic-era savings is actively altering consumer behavior at a structural level.
Which brings us full circle to the impending spinoff, right? A year from now, this new independent media company is going to consist of a newly profitable streaming service, a high-performing studio, and a theme park division actively battling macroeconomic headwinds.
And crucially, they will have to navigate those headwinds without the steady, predictable cash flows of the broadband business subsidizing their operations.
Right.
They will be a pure-play content and experiences entity.
The pipes will no longer pay for the programming. So does a standalone, untethered NBC Universal have the balance sheet to become an aggressive acquirer in a consolidating media landscape? Or do they immediately become a prime acquisition target for a tech giant looking to instantly purchase a turnkey entertainment empire?
That is the multi-billion-dollar question that will dictate the trading multiples of this stock for the next 12 months.
Definitely something to keep an eye on. To ensure your portfolio stays informed on the mechanics of this spinoff, the shifting margins across the telecom space, and the daily macro indicators flashing at the theme parks, make sure you follow the show for our daily earnings coverage.